Hello and welcome back to the American Dream Portfolio. In this current video series, we are exploring 4 emotions that increase investment risk, which we defined as the likelihood of selling your investments at a loss. In the last 2 videos, we looked at fear and anxiety. We also suggested that emotions can lead to a related threat, the likelihood that you will fail to reach for a meaningful gain. You may not lose money on a trade, but too much cash sitting on the sidelines for fear of a loss will erode your ability to purchase the lifestyle you seek. In this video, we travel to the other end of the behavioral spectrum until we reach a set of traits that we will encapsulate with one word: arrogance. Arrogance is not an emotion per se, but is certainly driven by emotions and insecurities. As we pick apart the behavioral makeup of arrogance, we find some key ingredients that put your investments at risk. Here are a select few. 1. The strong desire to be proven right in your investment decisions. 2. The belief that because you are successful in your primary field of occupation, you will naturally succeed as an investor. 3. You surround yourself with a feeling of bliss that all is well in your investment world. 4. The belief that you can accurately predict the future. In our earlier video entitled Investment Dynamics, we provided an example of how an investor might trap himself into the need to be right about an investment, regardless of the consequences. We have provided a link to that video in the description. It may be readily apparent that all 4 of these traits are related to an underlying feeling of superiority. Such superiority may become manifest in a number of beliefs, namely, a belief in having superior information, reasoning, experience, ability to duplicate prior investment results, and yes, even superior emotional control. We can see arrogance in action on any time frame, from the long-term investor to the trader who is in and out of a position in minutes, even in seconds. Let's look at a few examples. Consider the very skilled professional. The orthopedic surgeon, the high-powered corporate attorney, the politician who always gets re-elected. These individuals are used to success, they are used to deference and respect, they may even be used to wielding power and influence. How likely is such a person to be satisfied with a boring index fund like the S&P 500? Wouldn't the unique talents of professionals such as these be better matched with investments like the following? An exotic new hedge fund. A business colleague's private equity venture. A fancy new steakhouse in the trendy part of town. Data on individual investor behavior is scarce, but we do know that it is successful, high-net-worth individuals who are drawn to such risky investments. To be fair, the regulatory authority in these matters, the Securities and Exchange Commission, requires a high net worth to participate in most ventures of this type. But there is no law that says you should participate just because you are allowed to. These so-called opportunities are fraught with risk due to factors such as inherent complexity, inexperienced management, lack of a business track record, and the inability to value your investment or to cash out of it for several years. These non-public or alternative investments run the gamut from complete bust to fabulously successful. But because each one is totally unique, it takes a degree, not just of confidence, but of arrogance, to suppose yours is the one that will beat the odds. How about a less highbrow example of arrogance, one that even the investor of modest means can try their hand at? Investing in an IPO, or initial public offering. This is when a company's stock first becomes available to public investors. In an earlier video, we saw how Amazon stock fared in its first years as a publicly traded company. It went from an adrenaline price rush to a depressive crash. In the grand scheme of things, data reported by CNBC reveals that roughly 60% of IPOs show a negative absolute return after 5 years. And yet investors, both institutional and individual, flock to these offerings with money and enthusiasm. As of the date of this video, May 15th, 2026, the biggest IPO in history, SpaceX, is coming up shortly. This IPO seeks to raise $75 billion from investors, including private investors, and is based on a valuation in excess of $1.75 trillion. For those who have an uncanny ability to predict the future and are willing to overlook the extravagant valuation, This could be the opportunity of a lifetime. Pardon the sarcasm, that is not what we believe. Using the numbers just listed, SpaceX is presumed to be worth 8 to 10 times more than the average S&P 500 company based on last year's profits. In our view, making an argument for investing on or shortly after the IPO date, rather than waiting some months or years to see how company performance plays out, takes more than a small dose of arrogance. It will be instructive to follow the journey of SpaceX stock in the months and years after it goes public, but it is unlikely to ever be in our portfolio. When we look at the big picture of arrogance and emotion, we find evidence, such as from Morningstar and Vanguard, that investors underperform the very funds that they own by some 1% to 3% annually. This shortfall can add up to serious consequences after several years. In any case, how is it possible to underperform a fund you already own? This question can best be answered with one word: arrogance. Let's consider just one scenario of how arrogance works to sabotage good performance. Enter George, an investor who believes he has a very good handle on the current pattern of the market and the realities of the economy, and thus knows where both are headed. We will use the example of an individual stock rather than a fund, but the results would be essentially the same with either investment. It's April 2020, and deaths due to the COVID-19 pandemic are just beginning to spike throughout Europe and the Americas. Stock markets are down over 30% from highs made just 2 months before. George has been investing for a few years and experienced strong returns throughout 2019 with the stock index fund he owned. But the COVID crash threw him into a panic, and he sold his funds at a 10% loss. After licking his wounds, George resolved that he would not only recoup his losses, but would end 2020 with a satisfying gain. With the work-from-home mania just beginning to take hold, it didn't take George long to realize his ticket to a profitable year. That ticket came under the name of Zoom Communications. George was already using Zoom to connect with colleagues from his makeshift home office. Everyone was starting to use it. George decided to start tracking Zoom's share price. He could hardly believe his luck. The stock had more than doubled since the beginning of the year and was still rising. Every worker who used to sit at an office desk was now using Zoom instead. George saw this as the wave of the future, and this wave was only a few months old. He reasoned that the trend would eventually level off, but that could be years in the future, and by then he would have made a killing if he invested soon. He bought a sizable position in early June at $180 per share. By mid-September, Zoom reached $400 per share. He bought more. After running some numbers, George determined that, in order to show a nice gain for 2020, he would have to commit most of his available cash to Zoom. This he did in November at $440 per share. Zoom ended the year at a disappointing $337 per share. But George was unfazed. He was a patient investor and could see the future unfolding before his very eyes. He knew Zoom would bounce back. But Zoom never did bounce back, and in December of 2021, when the stock returned to $180 per share, his original purchase price, George threw in the towel. After just breaking even in 2020, George's account showed a 31% loss for 2021. Meanwhile, his index fund went on to post gains of 18% in 2020 and 28.5% in 2021. So much for seeing the future unfold before your very eyes. Such arrogance can be devastating to investors, yet a similar destructive scenario plays out with different investors and different investments day after business day. In our next video, we look at our final emotionally driven behavioral trait. It is one that all of Wall Street is supposedly guilty of possessing: greed. See you then.